Welcome back to the ProTicker Deep Dive. We are digging into a topic today that sounds, frankly, a little dusty, a little bit like the 20th century's old economy.
Right.
But it is, in fact, the absolute non-negotiable cornerstone of the 21st century's technological and, well, its energy revolution.
Oh, it really is.
We're talking about industrial metals, specifically copper, aluminum, and nickel. And these aren't just, background materials anymore,
That's
but
right.
they've undergone this profound status change. They've moved from just being cyclical commodities to being geopolitically critical strategic assets.
Mhm.
Our mission in this deep dive is simple. We want to give you the ultimate shortcut to understanding this huge structural shift by answering one critical question.
Okay.
Why are the materials that power your phone, your new EV, and the entire modern electric grid? Why are they facing a looming supply crisis right now?
That's the core tension we really need to explore. We've synthesized a very detailed industrial metals outlook across our source material, and they all, and I mean all of them, point to one definitive conclusion. The decade ahead is going to be defined by structural tension. You've got this robust, sustained, demand-driven almost entirely by global electrification, the energy transition, and increasingly digitalization.
And big stuff.
The really big stuff. And it's colliding head-on with a supply side that is just severely constrained. It's rigid. It's growing at a snail's pace.
So the central paradox we need to unpack for you is this. The world has committed to these net zero goals, right?
Yes.
And that requires unprecedented volumes of copper and nickel.
Absolutely.
At the same time, we're building out this massive AI infrastructure that also needs huge volumes of these metals. So why is it so incredibly difficult, so costly, and so slow to actually pull these materials out of the ground?
It's a supply chain puzzle wrapped in a geological problem with a big geopolitical ribbon on top. If you take away just one core idea today, let it be this.
Okay.
The long-term forecast is extremely structurally bullish for these commodities. That rigidity on the supply side, when you meet it with mandatory legislated demand growth, it just suggests we are heading into really tight markets.
With much higher price floors, I'm guessing?
With potentially much higher price floors even after all the short-term volatility shakes out. And just for context, one analysis we reviewed from S&P Global, it paints a dramatic picture. They project global copper demand will surge by about 50% between 2025 and 2040.
50%.
50. And to put that into perspective for you, global annual copper production right now, it sits around 25 to 26 million tons.
Okay.
That 50% surge in demand could lead to a catastrophic 10 million ton copper shortfall by 2040 if supply doesn't dramatically expand.
Wait. 10 million tons. That is equivalent to losing nearly half of today's annual global production capacity over the next 15 years.
That's it.
That's the severity of the challenge, and that's why we have to start at the beginning, right? Understanding why the supply side is so broken.
Let's do it.
That 10 million ton figure is, it's scary. But to understand why we get there, we have to start at the source, the ground itself. The story of constrained supply isn't about us suddenly running out of minerals. The Earth still holds vast resources. The issue is how impossibly difficult it's become to move from discovery to actual operation. So let's unpack that time factor first.
Yeah, and this is maybe the most shocking part. We've seen a staggering increase in the lead time needed to get a project operational. If you look back to the 1970s, a new copper mine, from the moment geological discovery was confirmed until the first ore was processed,
Start to finish.
took roughly 7 years. 7 years.
7 years is manageable. I mean, you can plan around that. You can project cash flows, but that is just no longer the case today. So what's the shocker number now?
Today, that lead time has more than doubled. Our consolidated research shows it now takes over 16 years on average to go from discovery to operation.
16.
16 years. That is long enough to take a first grader all the way through their college degree. That time frame fundamentally changes the entire risk calculation for any investor. It's arguably the single greatest factor setting up this structural deficit.
Okay, 16 years is not just a delay. That's an institutional failure to adapt. Why the monumental change? Is it just that the geology is harder, or is this bureaucratic friction?
It's structural friction. Overwhelmingly, it's driven by complex, multi-layered approval processes, extensive environmental impact assessments, lengthy community consultation,
And litigation?
and the guaranteed risk of litigation at every single stage.
Right.
We can use the United States, which is, trying desperately to reindustrialize and secure domestic supply, as the perfect case study.
Right. Tell us about the Resolution Copper project. That name comes up constantly whenever people talk about U.S. supply.
It does. Resolution Copper, it's in Arizona, and it is one of the world's largest undeveloped copper resources. A truly world-class deposit.
And it was discovered when?
It was discovered way back in the 1990s. As of today, 2025, it is still stalled. The initial timeline had production starting around 2020. That date's been pushed back indefinitely.
So why the stall after all that time?
It's years and years of litigation. It focuses on environmental concerns and, critically, on issues involving indigenous sacred land. The project requires a land swap that has just been mired in court battles, proving how powerful these social and legal factors are.
So having the world's best copper deposit under your feet means nothing if you don't have the social and legal license to actually get it out?
It means nothing. And even the initial regulatory steps, they're measured in decades, not years.
Wow.
Absolutely. Even the initial environmental reviews, these are the detailed assessments under NEPA, the National Environmental Policy Act, they've been known to drag on for 7 to 10 years alone.
Just the paperwork.
That's just the paperwork phase, before any kind of construction approval is even granted.
So the very rules designed to protect the environment are ironically creating a massive bottleneck for the materials needed to fix the environment. That's a profound conflict.
That irony is not lost on policymakers. Recognizing this bureaucratic red tape as a national security bottleneck, the U.S. government issued an executive order in March 2025.
What did it do?
It specifically tried to cut those NEPA review times for critical minerals projects like Resolution Copper down to under 2 years.
A shift from 10 years to 2 years is radical, but does anyone expect that to actually hold up in court?
That's the massive unknown. Whether those reforms survive environmental litigation and truly accelerate projects, well, that remains a very open question. The legal challenges are already mounting.
So that new 2-year timeline might be aspirational at best.
At best. And look, this isn't just a uniquely American problem. Permitting hurdles, social license issues, they're global. In Latin America, which is the heartland of global copper in Chile and Peru, the average review processes stretch from 5 to 15 years.
We saw that tension explode recently, didn't we, with the Cobre Panama mine? That was a huge supply shock to the global market.
It was a perfect, vivid illustration of political and community risk. Panama's giant Cobre Panama mine, a major recent source of new global supply, faced a temporary government-ordered shutdown in 2023. It was amid contract disputes and massive public protests over environmental issues and the economic terms of the contract. The protests were so sustained that the government felt compelled to intervene.
And they shut it down.
They shut it down.
Yeah.
It just underscores that having the resource isn't enough, that social license is a constantly negotiated, fragile asset.
Okay, so we have this issue of time 16 years to build a mine, which adds enormous risk. But we also have an issue of money. We need to talk about the what you called the austerity hangover from the mid-2010s.
Yes.
For nearly 5 years, roughly from 2015 to 2020, major mining companies globally just pivoted away from these massive, expensive mega projects. They got disciplined, they prioritized shareholder payouts over growth. Why were they so risk-averse?
They were responding to investor fatigue. Simple as that. The decade before was marked by these huge capital expenditure projects that often ran late, went billions over budget, and just failed to deliver the expected returns.
And investors punished them for it.
They did. And that forced miners into capital discipline. Now, this discipline was rewarded at the time, but the consequence now is a very sparse project pipeline. It's empty precisely when demand is peaking.
So we just don't have enough projects that were sanctioned during that low capex period to meet this surge.
We don't. And this leads us directly to the concept known as the incentive price.
Okay, let's unpack that. The market price is what you pay today. The incentive price is what?
The incentive price is the forward price point you need to justify investing in a brand new greenfield capacity project. It has to factor in all the known unknowns.
The 16-year lead time.
The 16-year lead time, the rising costs, the political instability, and the required rate of return for shareholders.
Okay, so here's the paradox. Even when current copper and nickel prices are near historical highs, copper's been around $10,000 per ton. Reports from firms like McKinsey note that the incentive prices needed to meet 2035 demand. They remain significantly above current market levels. Wait, if the price is already near a record high, but it's still not high enough to justify billions in new investment, that suggests the underlying cost structure must have fundamentally changed. What's driving costs so high that $10,000 isn't enough?
It's a confluence of factors. First, inflation across the supply chain is real. Labor, equipment, energy prices, they've all risen significantly.
Okay.
Second, miners are being forced to chase lower-grade deposits. They have to process more rock, sometimes twice or 3 times as much, to get the same amount of saleable metal. That dramatically drives up your energy and processing costs per pound.
And third?
And third, there's the risk discount we mentioned. If a project takes 16 years, the mining company is factoring in a huge risk premium. They need much higher certainty on returns decades from now.
Which translates directly into a higher required incentive price today.
It does.
So the price is high because the metal is needed, but the cost of getting it out is so astronomical that the price needs to be even higher just to start the next project. It's a terrible feedback loop for consumers.
It is. And to highlight the difficulty even established producers face, just to maintain output, let alone grow it, we have to look at Codelco.
Chile's state copper firm, the Titan.
The Titan. Traditionally, they account for nearly 30% of global copper mine supply.
Codelco is Chile's national champion. So if they, the biggest producer in the world, can't maintain output, isn't that a massive political and operational failure?
It's both. Codelco has been struggling intensely. Our sources indicate they're failing to deliver on key expansion projects, facing massive cost overruns, and suffering funding issues. They're struggling just to maintain output.
What's the phrase the industry uses?
Industry observers have called Codelco's situation a state of permanent cash-strapped stagnation.
Cash-strapped stagnation. That's brutal for the world's biggest copper producer. What are they specifically failing to deliver on?
They're struggling to transition from their older mines to new, deeper sections. That requires massive capital investment in new infrastructure, like underground tunnels and ventilation.
And they have other issues too, right? Water scarcity.
Exactly. Water scarcity is a huge one. And declining ore quality, which just means you're processing more rock for diminishing returns. So if the world's largest state-backed producer can't reliably maintain its historic output, the global deficit just naturally deepens. It removes the largest stabilizing force from the market.
Okay, moving on from that, we hit a fascinating contradiction that sits right at the heart of this whole energy transition, the ESG paradox.
Yeah.
Everyone agrees decarbonization is essential. To decarbonize, you need grids, EVs, renewables, all of which require vast quantities of mined materials.
Right.
And yet, ESG concerns environmental, social, and governance often make the financing and permitting of new mines harder, thereby actively limiting the very supply needed for the transition. It's a classic catch-22.
It's the ultimate friction point. A perfect example is what Rio Tinto experienced in Serbia. Despite lithium being absolutely critical for the battery transition, Rio Tinto ultimately chose to walk away from a promising project there.
The Jadar project.
The Jadar lithium project in 2021. And why? Because of massive public protests over the project's environmental footprint. The company decided the reputational risk of pushing forward was just too high.
So in that instance, the S and the E in ESG were powerful enough to halt a project of global significance for the clean energy transition.
Exactly. It shows ESG acting as this powerful supply governor. It ensures that only projects meeting the highest and often most expensive and complex standards can move forward, and that increases costs and adds years to the timeline.
At the same time, we're seeing this rise of resource nationalism.
Yes, the friction is geopolitical too. Resource-rich countries, particularly in Latin America and Africa, are moving away from just exporting raw minerals. They're asserting control to capture more domestic value.
Indonesia pioneered this approach with nickel, didn't they? They turned themselves into the dominant global player almost overnight.
Precisely. Indonesia banned nickel ore exports in 2020. That was a game-changing policy. It forced massive capital investment, primarily from China, into domestic processing facilities.
And now others are following that playbook.
They are. This strategy is now being replicated. Zimbabwe has banned raw lithium exports. Namibia is restricting unprocessed lithium and cobalt. These policies force companies to build domestic refining and manufacturing.
Which is smart for them, politically.
It's very smart for the host nations. But it significantly raises the barrier to entry and can cause these short-term supply chain dislocations for importing nations.
So if it's hard to get a permit, expensive to finance, and politically risky, what about the people needed to actually run these massive operations? That's the final structural constraint, isn't it?
That brings us to the labor cliff, which is a silent but really deadly supply risk. Mining is a highly skilled, specialized industry, and it is facing a severe aging workforce crisis.
What are the numbers on that?
Consider this staggering statistic from the U.S. Over half of the entire mining workforce, that's about 221,000 workers, is expected to retire by 2029.
Wow, over half.
And that massive turnover is not being met by new talent entering the sector fast enough to replace them.
And if you have an aging workforce, you lose institutional knowledge, and you face wage inflation as companies fight over a shrinking pool of skilled people.
Precisely. This shortage adds significant costs and often delays projects because you just can't ramp up complex operations without experienced management.
Yeah.
We also see it in things like the periodic and economically damaging labor strikes in Chile and Peru.
So you have ESG constraints, resource nationalism, and an aging labor force. It's a perfect storm of friction on the supply side.
It's a perfect storm. It guarantees that supply will struggle to keep up with demand in the decade ahead.
We've established just how sticky and, well, how rigid supply is. It's facing these decade-long delays and soaring costs. Now, let's pivot entirely to the demand side.
Okay.
Because if supply is growing at a snail's pace, demand is roaring ahead like a freight train, and it's driven by these huge structural, non-negotiable trends.
This is the game-changer quality of the energy transition layered with digitalization.
We have to start with electric vehicles. The data here is essential for you to grasp the structural shift in metal consumption. A single battery electric vehicle contains 3 to 4 times as much copper as a traditional car.
3 to 4 times. And that copper is everywhere. It's in the electric motors. It's in the massive wiring harness connecting the battery to the drivetrain. It's in the high-capacity charging infrastructure that needs to be installed everywhere.
It's a huge multiplier effect.
It's an immense, sustained multiplier effect. And while lithium and cobalt grab the headlines, nickel is equally vital. It is indispensable for the high-energy density batteries, NMC and NCA cathodes, which are preferred for longer-range vehicles.
So every new long-range EV being built right now is structurally locking in demand for nickel.
Exactly.
But the EV effect is only part of the story, and arguably not even the biggest part. The truly massive demand is coming from grid expansion and infrastructure.
That's the silent giant of demand. The International Energy Agency's net zero pathway is unequivocal about this. It calls for the world to triple global grid capacity by 2040. Triple the global grid to handle intermittent renewable energy and massive power transfers.
Tripling the global grid sounds like a massive undertaking and a massive metal undertaking.
It is. This requires extraordinary volumes of metals for new transmission lines, distribution cables, thousands of new transformers. China, for instance, is making these huge investments in ultra-high voltage grids, which consumes colossal amounts of aluminum and copper.
And the U.S. Infrastructure Act is aimed at similar upgrades.
The same thing. The sheer scale of the cabling and wiring needed is difficult to overestimate.
And copper's unique properties for conductivity make it almost irreplaceable in a lot of these applications, right?
Its criticality is underlined by specific comparisons. I mean, think about power generation itself. An onshore wind plant requires 2.5 times more copper per megawatt than a conventional gas-fired plant.
2.5 times.
And offshore wind is even higher. Solar farms also need significant copper, so clean energy applications, taken all together, accounted for about 24% of global copper demand in 2021. Our analysis suggests this share is structurally set to rise to 35% or more by 2040. Copper is now officially the metal of electrification, and its demand growth is baked in for the next 2 decades.
And as if managing the energy transition wasn't enough, we have an entirely new, unanticipated, and explosive source of demand emerging.
The AI revolution and the resulting data center build-out.
The pace of AI infrastructure growth has been staggering. How does that translate to physical metal demand?
Well, data centers are enormous consumers of electrical power, and therefore enormous consumers of electrical infrastructure. Modern high-density data centers need this complex, dense copper architecture for wiring, for bus bars, transformers, cooling systems.
To handle the massive power requirements of all those new AI servers and GPUs.
Exactly. This rapid expansion we've seen has cemented digitalization as a non-trivial source of copper demand. One report even suggests that global copper demand could surge an extra 24% by 2035, largely due to this AI-driven build-out.
And this demand isn't elastic, is it? It's not like if the price of copper goes up, the data center builder says, oh, maybe we'll just use less of it.
Absolutely not. This is a crucial distinction. Firms like Wood Mackenzie highlight a finding that really illuminates the inelasticity. They said data center developers will literally pay whatever it costs to secure copper.
Why that urgency?
Because the developer isn't looking at the price of copper in isolation. They're looking at the price of not being able to run their AI servers and fulfill massive cloud contracts. Copper is mission critical. Its cost, while large, is still a small fraction of the total multi-billion-dollar project.
They're buying the equivalent of oxygen for their operations.
Exactly. Price sensitivity is near zero. The practical implication is that a sudden wave of data center construction can trigger significant copper price spikes, maybe 15% or more, in a very short time frame. This inelastic digital demand layer is a massive, underappreciated upside risk for copper prices.
And the final structural driver here is policy. Governments aren't just observers in this. They're actively shaping demand through massive stimulus packages and legislative mandates.
They're providing an unprecedented structural lift. Let's start with the U.S. We've seen the rollout of huge domestic spending bills.
Right.
The Infrastructure Investment and Jobs Act and the Inflation Reduction Act dedicate hundreds of billions to infrastructure upgrades, grid modernization, and domestic manufacturing. The IRA, in particular, just accelerates demand for copper and nickel by subsidizing EVs and spurring a flurry of massive battery plant construction.
And this policy framework is so significant that the U.S. government took a major step.
It did. The Department of Energy recognized the risk to supply. In 2025, they designated copper as a critical mineral for the first time. This isn't just an academic label. It explicitly recognizes the risk of supply shortfalls constraining U.S. electrification and national security. It makes securing copper a matter of state policy.
Meanwhile, China, the world's largest consumer, is undergoing a profound rotation that maintains its massive demand, even as its property engine slows down.
That's the key structural nuance. For years, the major driver of Chinese metal demand was property and construction. That engine is now visibly weakening.
But something else is taking its place.
Exactly. That weakening driver is being systematically offset by Beijing's robust, metals-intensive push into green infrastructure. We're seeing massive expansion of the national power grids, high-speed rail, renewables installations.
So private demand from housing is down, but public demand for the grid is surging to compensate. That sounds like a powerful counter-cyclical force.
It is, and if you look globally, public sector support for metals demand is unusually strong. You have the EU's Next Generation EU Fund. You have India sharply increasing its capital expenditure. This legislated multi-year spending provides a real counter-cyclical buffer against private sector downturns.
So policies are now functioning as a fundamental support system for industrial metals demand.
That's right.
So the structural story is clear. You have rigid supply colliding with accelerating legislated demand. But the metals market is never a smooth escalator. It's a volatile roller coaster.
Always is.
Short-term volatility and sharp price swings are often dictated by regional policy decisions and the massive force of inventory dynamics. And China remains the massive swing factor here.
China's purchasing behavior demonstrates an incredible level of strategic price sensitivity. They use their vast inventories as a critical balancing force in the global market. They can soften or amplify global price moves.
Can you give us an example of how this inventory cycling works in practice?
We saw it play out perfectly in late 2025. When global copper prices spiked to a record high, breaching about $11,700 per ton, China's immediate response was not to panic buy.
What did they do?
They pulled back significantly. They slashed their refined copper imports, which dropped 19% year-on-year in November. They just drew down their existing stock and waited for the price to correct.
Which contrasts sharply with their strategy when prices are low.
Exactly. While copper was spiking, China was simultaneously ramping up purchases of lower-priced commodities, like crude oil and iron ore, to build their strategic inventories at favorable costs.
So they build stocks when prices are favorable and draw down or hold off when prices surge. It's highly disciplined.
It is. This inventory cycling acts as a sophisticated market shock absorber. However, it also means that the price volatility we see in London or New York is often amplified by China's sudden entry or exit from the import market.
This means that while China's construction sector remains weak, the potential for a sudden massive demand surge is always looming if Beijing decides to go big with stimulus.
It's the ultimate upside risk. If China decides to unleash a new wave of massive stimulus focused on green infrastructure or boosting domestic consumption, the global market will tighten overnight. We saw signals of this in 2025.
With the auto incentives.
Yes. Measures like auto trade-in incentives were rolled out. This directly stimulated manufacturing and led to Chinese auto production and sales jumping 11% year-on-year in the second quarter. Any focused stimulus of that magnitude could quickly turn the global copper and aluminum markets much tighter.
Okay, we must now discuss nickel, which is the massive outlier in this general bullish structural narrative. While copper and aluminum face tightening markets, the short-term outlook for nickel is decidedly bearish to neutral.
Yes, due to an extreme, deliberate oversupply.
And this entire narrative is driven by one country, Indonesia. Following its 2020 ban on raw ore exports, Indonesia has just poured massive amounts of capital into domestic processing.
The change is breathtaking. Indonesia went from accounting for 30% of global nickel supply in 2020 to approximately 70% in 2024.
70%.
That is a geopolitical and industrial shock. No other major commodity has seen one single nation flood the market so successfully and quickly in recent memory.
And the consequence of that has been an inventory explosion.
A huge one. Global exchange inventories of refined nickel went from a mere 54,000 tons in early 2023 to an astonishing 366,000 tons by late 2025.
Let's pause on that number. 366,000 tons. What kind of buffer does that represent?
That buffer is enormous. It's equivalent to about 10% of annual global usage. And when you have a stockpile that large hanging over the market, prices cannot recover meaningfully.
So they've been languishing.
Languishing near the marginal cost of production, struggling to hold that $14,000 to $16,000 per ton range. Many higher-cost producers elsewhere, in Australia or North America, are now losing money and facing shutdowns.
This seems counterintuitive, though. If we need nickel for EV batteries, why hasn't that massive demand surge absorbed the supply?
Because the market is not homogeneous. It's starting to bifurcate. The massive oversupply from Indonesia is mostly in low-grade nickel, known as Class II, which is suitable for stainless steel. That's where the glut is.
But EV batteries need high purity, Class I nickel.
Exactly. And the key nuance is that Indonesia is aggressively building what are called HPAL high-pressure acid leach plants to produce high-purity battery-grade nickel. This process is expensive and technically challenging, but it converts their abundant low-grade ore into battery feedstock.
So we have too much stainless steel nickel, but what about the battery-grade stuff?
The projection is that by 2027, the market could be in this bizarre situation of having way too much low-grade nickel, but only just enough high-purity nickel for the batteries the world needs.
So the price for the high-end product could still recover strongly, even if the overall price is weighed down.
That's the theory. Nickel is essentially trading as two different commodities now.
This volatility highlights that even in a structural shortage, markets don't simply absorb endless price increases. There is always the risk of demand destruction through substitution.
Absolutely. The first major substitution threat is copper versus aluminum. Copper is superior for conductivity, but it is also heavy and expensive. If copper prices remain sustained at extremely high levels, say consistently above $10,000 a ton, it triggers technological substitution.
Didn't this happen historically?
It did. We saw a major push for substitution in the 1970s. Today, sustained high prices could see significantly increased use of aluminum wiring in construction and automobiles. Aluminum is lighter, cheaper, and perfectly adequate for many lower voltage applications. This risk acts as a natural ceiling on copper prices, though that ceiling is clearly much higher than it was a decade ago.
And the second and perhaps more potent substitution threat is for nickel, and it's driven by battery chemistry.
That's the LFP threat. We're talking about LFP, or lithium iron phosphate, batteries. This chemistry uses iron and phosphorus for the cathode instead of nickel and cobalt.
Why are they threatening nickel demand so much?
They are structurally cheaper, they're safer, less prone to thermal runaway, and they have a longer cycle life. And while historically they were less energy dense, meaning shorter range for EVs, new generations of LFP are rapidly closing that gap.
Making them more viable.
More viable for mid-range vehicles and, critically, for grid-scale energy storage. LFP already commands about 50% of China's EV battery market, and it's expanding globally.
Tesla and Ford are using them.
Exactly, for some entry-level and commercial vehicles. So if LFP continues to expand its global dominance, nickel demand could fall short of the most bullish projections. LFP is a massive wild card that prevents nickel from simply mirroring the copper supercycle narrative.
We've established the core themes. Supply is rigid, demand is accelerated by electrification and AI, nickel is the volatile outlier. Now let's synthesize what this means for the long term.
Okay, where we are heading in terms of strategic competition and capital flows.
We have to begin by reiterating that long-term risk because it dictates everything. That S&P global forecast of a 10 million ton copper shortfall by 2040, It's a structural gap that cannot be solved by existing projects.
It can't. And that gap is due to the scarcity of new, massive copper discoveries and the persistent trend of declining ore grades in existing mines.
So this structural gap fundamentally changes the geopolitical landscape. Scarcity breeds competition.
It does. We are seeing intensifying competition for resources, particularly as the West becomes acutely aware of its supply chain vulnerabilities. China currently dominates the midstream processing.
What's the number for copper refining?
China accounts for about 60% of global copper refining capacity, and it has a similar dominant position in nickel and aluminum. The West is increasingly uneasy about this level of dependency.
So we are seeing the acceleration of friendshoring. What does that mean in practical terms for the metal supply chain?
It means actively diversifying supply chains toward perceived allies like Canada, Australia, Chile, even if the cost is slightly higher. The long-term implication is clear. We could see two distinct and definitely more expensive supply chains emerge by 2035.
A China-aligned one and a Western-allied one.
Yes, this geopolitical bifurcation adds friction and cost to the global metals trade, but it's now seen as necessary risk mitigation.
And the most significant strategic shift is the increasing intervention by governments to secure this supply. These are moving from economic commodities to national security assets.
Absolutely. The official designation of copper as a critical mineral by the U.S. in 2025 is the signal. It means governments will increasingly intervene to secure supply that the market might otherwise fail to deliver quickly enough.
So what does that intervention look like?
We've seen the U.S. authorize $2 billion for strategic stockpiling of critical minerals. We are also seeing pushes for loan guarantees to de-risk new mine development and new partnerships with producer nations. This marks the profound shift from a purely market-driven environment to one where these materials are central to national strategic toolkits, much like oil in the 20th century.
Okay, despite the dire forecasts for supply, the rocketing demand, and strong prices, we're seeing this strange valuation paradox in capital markets.
We are.
If you look at many major mining stocks, like Rio Tinto, they trade at compressed multiples, around 10.8 times forward PE.
Yeah.
That valuation reflects skepticism from generalist investors. They're treating these companies as deeply cyclical stocks nearing a peak. Why the disconnect between the long-term reality and the current valuation?
Generalist investors have been burned too many times. They have a muscle memory that says commodity prices go up, then they crash. They're pricing in a temporary boom, not a structural transformation.
They're skeptical the long-term deficit is real.
Exactly. But this skepticism is being heavily countered by specialized thematic capital flows. While the generalists remain cautious, specialized investors who understand the structural deficit are piling in.
Can you give us an example of those thematic flows?
A clear example is the Global X Copper Miners ETF, which is CUPEX. It was up about 95% year-to-date in 2025.
95%.
That is explosive growth. It indicates a massive, strong rotation into copper equities by investors who believe in the structural deficit narrative and are willing to bet on the miners positioned to benefit. This dichotomy shows the market is split.
So if the market, through those generalist investors, won't adequately fund new exploration, what does that mean for industry consolidation?
It sets up the clearest M&A signal we could ask for. Since major miners cannot reliably build new capacity in 16 years, they will increasingly look to buy rather than build.
That makes sense.
As the hunger for secured copper exposure grows, large mining firms like Glencore's high-profile attempt to acquire Teck Resources will dominate headlines. We should expect intense consolidation as larger firms acquire promising, earlier-stage deposits from smaller companies, simply to ensure their future production volumes. M&A becomes the fastest way to shorten that 16-year lead time.
Okay, despite the strength of the structural demand, we must acknowledge the immediate risks that can disrupt this narrative.
Of course. The single largest risk remains the China macro wildcard. If the property crisis deepens unexpectedly and China's infrastructure spending falters dramatically, that sharper-than-expected slowdown could significantly weaken short-term demand across aluminum and copper.
Causing a temporary price dip.
A painful one. The market is still extremely sensitive to Chinese economic health.
But the flip side is that massive, underappreciated upside risk, the digital demand layer. The AI and data center boom is an inelastic source of copper usage that is not yet fully priced into long-term models. It's mission-critical and price-insensitive. This demand could create unexpected, sharp demand shocks that even the bulls haven't fully accounted for.
The speed and scale of AI build-out is outstripping traditional forecast models. And finally, we have to consider how climate change itself acts as a supply constraint.
The irony.
It is an irony we must address. While climate mitigation drives demand, the consequences of climate change extreme weather events can reduce actual production. We're talking about floods disrupting logistics, or perhaps most critically, water scarcity in arid mining regions like Chile or the southwestern U.S.
Copper processing needs a lot of water.
It needs massive amounts of water. Water scarcity forces mines to curtail production or invest billions in desalination plants. These factors add unexpected friction to the supply side, which is a bullish risk for prices that is very difficult for markets to quantify and price in.
So, to summarize this deep dive, we have traced the dramatic journey of copper, aluminum, and nickel from background materials to absolutely indispensable strategic assets. They are trapped between robust structural demand driven by electrification, digitalization, and massive government stimulus, and these rigid supply constraints.
Characterized by ballooning 16-year permitting times, a historic austerity hangover, and rising ESG scrutiny.
The implication is profound.
It is. The global market is rapidly transitioning from a period where these were simply cyclical commodities traded on a balance sheet to one where they are central to national security and economic strategy. Our sources suggest the world is truly entering an era where critical minerals take on a strategic importance akin to oil in the 20th century.
With states actively intervening via stockpiling and partnerships to secure their long-term supply. So, if the sustained structural deficits materialize as predicted, and the evidence suggests they will, we might indeed be entering a supercycle. A prolonged period where prices remain elevated and volatile for years. But this era of scarcity will also force a dramatic technological pivot, either toward greater substitution, like more LFP batteries and more aluminum wiring, or a dramatic shift in how governments and investors engage with resource-rich, high-risk regions.
A real reckoning.
So for you, our listener, the provocative thought is this. We need a breakthrough that is faster than 16 years. What technological breakthrough do you think has the power to solve the coming supply crunch?